Well, let's get some perspective going with our market master of the day. Harsha Upadhyaya is President and Chief Investment Officer, Equity at Kotak Mahindra Asset Management Company. Harsha, good morning. Great to have you with us here on the program on CNBC-TV18. Just a quick word, Harsha, on the flux we're seeing out there in the market, and does it add to the complexity? You guys have been pointing out that valuations have been a little problematic. In January, we got a 3.5% fall, at least on the Nifty, larger for mid and small caps. But all of that was bought back double quick. And now we find ourselves with some geopolitical flare-up impacting risk assets. Do you think even without this, things perhaps stay a little quiet sideways for the next couple of months?
Good morning, Prashant. Yes, our view remains the same. We do believe that valuations continue to be the primary risk for the market at this point of time. Along with that, as you rightly mentioned, the Middle East conflict also seems to be escalating. We need to watch that space. And also how it impacts the crude oil price. I think that's going to be very, very important. Not just for the crude oil derivatives, but for most of the companies, the margins are dependent on how crude oil behaves, either in terms of raw material or in terms of fuel cost. So to that extent, I think already we have seen our EBITDA margins at one of the highest levels. It's unlikely to go higher even with the operating leverage. And along with that, if you have margin impact coming up because of crude oil prices, then that would be negative for the markets. And as we have discussed in the past as well, at current valuations, it doesn't leave any room for disappointment. So the earnings delivery is really, really crucial for the markets to sustain these levels or go higher from these levels. So to that effect, I think what happens in Middle East is going to be very crucial in the very short term.
So would you tilt your portfolio more towards the defensive, safer stocks right now? Is there any portfolio adjustment that you would recommend to tide through these times?
Probably not, because those which are defensive seem to be struggling with their business momentum. For example, FMCG has its own issues with consumption trends continuing to be weak. IT, as we have seen, the results have continued to be weak. The outlook continues to be really, really lackluster. So there are no real defensives in terms of sectors at this point of time. But I think banking could be one where probably the valuation risk is less compared to many other sectors. However, I'm not suggesting that the Middle East conflict is definitely going to flare up and that's going to have a longer term impact on the markets. We need to be watchful of these valuations is all that I'm saying.
Okay, all right. Hi, Harsha. Good morning and good to see you. When we last spoke, you were neutral on IT and with preference for large cap over mid cap. Accenture, well, they sounded the alarm bell out there. And now you have Infosys numbers that are fairly disappointing with benign guidance, which is weighing on the markets. What's your stance now? Do you continue to maintain the neutral stance with the preference for large cap?
Nigel, probably we have booked some profits in the recent times when there was a up move in the IT sector. So to that extent, maybe it will be slight underweight to benchmark at this point of time. And as you rightly mentioned, the results that we have seen initially have not been inspiring. Even the outlook that has been outlined by management doesn't seem to be inspiring confidence. Most of the verticals are showing continuous pressure, except for probably high-tech and communications verticals. The overall consumer discretionary spend that we are seeing is also on the lower side. So overall, it doesn't seem that immediately there is going to be anything that's going to excite the markets from the IT sector. Yes, the valuations have cooled off, especially in the last month and a half. So to that extent, probably in a falling market, it will give you some kind of a defensive bias. But other than that, I think immediately unlikely to outperform the market.
Right. Harsha, the other sort of sector which has done very well is pharmaceuticals. Just a quick word there. We had the management of Lupin recently with us, and we were asking them about the US generic pricing. They were saying it's still the fall is in single digits. There are expectations that that price fall becomes neutral. We don't know if it will swing on the other side, but if it does, I mean, that's going to be quite something. Stocks have done very well, but what's your sense, Harsha?
Yes, on the US generic pricing, I don't think there is a common thread. It all depends on which portfolio each of the pharma companies are looking at and at what stage they are in the US generics business at this point of time in terms of the new molecules, etc. So overall, I would say that it's still a sector where you can have a neutral position at this point of time. Overall, domestic growth as well as exports growth continue to be reasonable. There are no real large regulatory headwinds at this point of time. So overall, I think it can be a neutral exposure in the portfolios.
So IT is slightly underweight. Pharma is in neutral. Banks, I believe you're overweight. Any other changes that you've made? Tweaks in your weightage?
No, we are not overweight on banking and financials.
Okay.
We do have some positions there, but it's still an underweight. Most of our overweight is still in some of the domestic cyclicals, such as industrial, cement, automobiles, auto ancillaries, some of these sectors. Continue to bet on the cyclical part where demand continues to improve. And yes, the margins may have peaked in some of the sectors. The valuations may have been on the higher side. But still, when you look at next couple of years, I think these are the segments where there is going to be reasonable level of demand growth, and also profitability growth should be higher than that of the market.
Okay. Well, for the time being, the Nifty Bank has taken support at around that 100 EMA. We're seeing some kind of a bounce from those levels. So that's good to see, because the largest part of the market is giving some kind of support. Harsha, the other focal point today is Bajaj Auto. The numbers look good. Good margin improvement. Commentary as well, fairly decent. The problem is how much is in the price. And I was looking at two notes from Citi as well as CLSA. They are sounding a little bit cautious on the exports front, which actually has been lacking, but they are not too enthused that in the next 2 years, you're going to see any kind of big growth. What's your view on the two-wheelers, and what's your preference out there?
I won't be able to make any stock-specific comments, Nigel. However, we continue to be positive on two-wheelers within the automobile segment. After a long time, we have seen volume growth sustaining, and also the impact of two-wheeler electric vehicles seems to be not as much as what the market was fearing earlier. The margin profile has also kind of improved. However, across the sector, the valuations are not same. So to that extent, you need to look at valuations from a bottom-up perspective and then take a call on the sector. But from a demand perspective, I think things are fine in the sector.
Okay, so just give us a little bit more color on this positive stance on the two-wheeler segment. Would you prefer the export-related name, or do you prefer the domestic name, or maybe in fact the one that's more into premiumization, where even if EVs come in, you have larger bikes that are being sold, so it doesn't really impact them. Give us a little bit more color on this positive stance that you have on two-wheelers.
Domestic demand continues to be stronger than the exports market at this point of time. And in terms of premiumization, I think that's across the board, not just in two-wheelers. I think whichever consumer segment that you are looking at, since the wealth effect has been much higher at the upper end of the economy, I think the premiumization is still continuing. I think these two trends will continue to drive overall larger demand and will have more impact on the two-wheeler segment as far as we are concerned. I think exports is still something that needs to be watched. There are certain markets which are not as good as what they used to be in the past. So maybe you will need some more time for export markets to stabilize.
You know, by the way, just a quick look at the market, right? I was talking about the lack of volumes. Well, on the downside, market breadth is still negative. If you count number of stocks down and up, it's still in favor of what number of stocks which are down. And volumes are still lacking on the way down, but volumes are picking up on the way up in the broader market. All right, so I was just able to count 5 names with volumes, but that list is becoming longer now. Let me just tell you, Bajaj Electricals, for example, 2.5% higher. So there is it just shows you interest. KM Sugar is up 9%, 40 bucks. It's got large volumes for this point in the day. There is KEI, which is up 2%. It's done very well. It's got decent sized volumes. Premier Explosives, I think 3% higher, decent volumes. RK Forging, that sort of agreement with, of course, the management did not confirm it, but perhaps in all likelihood with Tesla, many-year agreement. Stocks up slightly, but there are volumes here. High-tech gear is up 2.5%, and it's picking up. That's the point that I'm wanting to make on the way up, even though overall, numerically, declines outnumber advances. Harsha, just one quick word on flows. You know, we were talking about the last month AMC numbers, and we saw a shift away from small cap funds, etc., towards large caps. Has that continued into April so far?
Yes, in a way, I think the overall numbers in mid and small cap category seems to have been slightly lower than the trend number that we used to see for the entire financial year last year. However, I mean, it's too early to call out that the small cap flows or the mid cap flows are going to definitely reverse from here on. I think it's just a bit of valuation concerns that's running on the minds of most of the investors, and probably some profit booking that's also happening.
Harsha, great conversation. Thank you very much for joining us on this important day.